All right, let's kick off today's deep dive. Get ready, because we're going headfirst into some Wall Street jargon.
Oh, yeah. Like what?
The kind of stuff that might make your head spin a little. Bull markets and bear markets, that sort of thing.
Ah, got it. The classic market metaphors.
Exactly. It's like, picture the market as this wild animal. Sometimes it's charging ahead. Other times it's like retreating to its den.
Makes sense. A pretty good way to think about those market swings.
So to really get a grip on these market animals, we're going to be diving deep into a YouTube video.
Ooh, what video?
It's called, get this, Bull versus Bear Market Explained, 2024. Differences between bullish and bearish.
Catchy.
Right. And it's from a channel called Riqueza Vital. They've got some pretty neat insights on how to handle these market conditions.
Sounds interesting. Let's hear it.
So right off the bat, this video jumps into this whole 20% threshold thing.
20%? What's so special about that number?
Yeah, that's what I was wondering too. Why is this number such a big deal?
Well, think of it this way. It's like the magic dividing line. It separates a real market trend from just like a little blip.
Oh, okay.
So the video says a bull market is officially a sustained upward trend where prices go up and get this 20% or more from their recent lows. And on the flip side, a bear market, that's when prices take a tumble. They drop 20% or more, but from their recent highs.
So it's not just like a gut feeling. There's an actual number we can look at.
You got it. That 20% benchmark, it's like a clear signal that helps us see whether it's a short-term hiccup or a more serious shift in the market.
Makes total sense. So we've got the numbers down, but what else makes these markets so different?
Right, because it's not just about the numbers, is it?
No way. The video talks about how investors act differently in these markets, like their behavior really changes.
Totally agree. In a bull market, everyone's super optimistic.
Like riding that wave.
Exactly. Investors are feeling good, they're buying like crazy, and that pushes prices higher.
It's almost like the higher prices go, the more confident people get, and that just keeps pushing things up even more.
Yeah, like a feedback loop.
But then enter the bear market, and the whole mood flips. Right?
Oh, yeah, totally different vibe. It's like fear and pessimism all around.
No more party.
Nope. Investors get all nervous, they start selling off everything, and, well, you can guess what happens next.
Prices tank even more.
Yep, it's like everyone's trying to squeeze through the exit at the same time.
A stampede out of there.
You got it. And the video points out that understanding how this fear and greed thing works, how people's emotions drive the market, that's a super valuable insight.
Definitely. Okay, so we've got a handle on the definitions, the whole mood of these markets. But what actually triggers these big shifts in the first place?
Yeah, good question. What sets the whole thing in motion?
The video mentions a bunch of different factors, some pretty interesting ones, actually.
Well, it's never just one thing, right? It's a whole bunch of stuff, both like economic factors and what's going on in people's heads.
Complicated.
For sure, but let's take an example. A booming economy, that's often a sign that a bull market's coming.
Booming.
Yeah, like when unemployment's super low, people are spending money left and right, and maybe the government's doing stuff to encourage investment, like tax cuts, that kind of thing.
So basically, a healthy economy gets everyone feeling bullish, ready to charge ahead.
Exactly. But then there's the flip side, what brings on those bear market slumps.
Yeah, what makes the bears come out?
Economic recessions are a big one. When the economy slows down big time, stock prices usually follow suit.
Makes sense.
And the video also highlights other things that can trigger a bear market, like rising interest rates. That makes it more expensive for companies to borrow money, which can lead to, well, less investment and the economy shrinking.
Wow, so it's like one thing can set off this whole chain reaction and eventually, bam, bear market.
Yeah, pretty much.
But is it always about the economy? I feel like sometimes what's happening in the world, like big global events, can really shake things up in the market.
You're totally right. Stuff like wars or major political instability, those can send shockwaves through the global markets. It's like everyone rushes for the exits.
So it's not just about what's happening in our own country, but what's happening everywhere else, too.
Exactly. It really shows how connected everything is, how one event somewhere can impact us all.
It's kind of crazy to think about.
It is, and that's why it's super important to stay informed, not just about our own situation, but what's happening globally, too. The big picture stuff that can shape the market.
Totally agree. But even with all this info, is there a way to actually spot when a bull or bear market is about to, make a move?
Ah, the million-dollar question.
Right. The video mentioned something called volatility as a potential clue.
Volatility, huh?
Yeah, but I'm not really sure what that means, honestly.
So volatility basically measures how much prices jump up and down over time.
Up and down, like a roller coaster.
Sort of. Think of it as the market's heartbeat. Calm and steady. That's low volatility. But if it's going all over the place, super jumpy, that's high volatility.
Okay, I'm starting to see how this volatility thing could be useful. So how does it actually play out in a bull versus a bear market?
Well, in a bull market, volatility tends to be pretty low. Prices are mostly going up in a nice steady climb.
Makes sense. Everyone's feeling good, so there's less panic.
Exactly. But when a bear market hits, things get a lot wilder. Prices can drop suddenly and fast.
I see.
And that creates a ton of uncertainty and fear.
So, to put it simply, bulls like a smooth ride up, while bears are all about those crazy drops and twists.
You got it. And, the video makes a really cool connection between volatility and that whole fear and greed cycle we talked about before.
Oh, right. So when prices are going up, greed kicks in. People want to buy more and more, even if the price is getting a little ridiculous.
Exactly. And then when the market starts to dip, fear takes over, everyone's selling like crazy, and that just makes prices drop even faster.
So basically, understanding these emotions and how they tie into volatility can help us avoid some major investment blunders.
100%. It's all about recognizing when our emotions are driving the bus and making sure we stick to a solid investment strategy instead.
Okay, we've covered a lot of ground here. We've got the market moods, the causes, even a little bit of market psychology. But let's get practical. How do we actually handle these markets, both the exciting highs and the terrifying lows?
Now we're getting to the good stuff, the how-to part.
Right. And lucky for us, the Riqueza Vital video has some really insightful strategies for both bull and bear markets. We'll be unpacking those in the next part of our deep dive.
We've got a lot to cover. Long-term investing, finding those safe haven assets, and even, get this, short selling.
Wait, short side? That sounds kind of intense.
Oh yeah, it can be, but don't worry, we'll break it all down.
I'm definitely intrigued. So make sure you join us for part 2 of our deep dive, where we'll get into the nitty-gritty of making smarter investment decisions in any market condition.
It's gonna be good.
All right, welcome back to our deep dive into bull and bear markets. We're picking up right where we left off, ready to dig into some of those practical strategies from that Riqueza Vital video.
Yeah, remember. We talked about what these markets are, but how do we actually navigate them?
Exactly. So let's start with those bull market strategies. What do they suggest?
Well, one of the most common approaches, and probably the one you've heard of before, is long-term investing.
Oh yeah, that whole buy and hold thing, right?
Yep. But what does that actually look like, in the real world?
Good question. It sounds kind of simple, but I'm sure there's more to it.
Think of it like planting a tree.
A tree, okay?
You pick a good sapling, one with strong roots, potential to grow big and tall, and then you got to give it time, let it mature.
So you're saying with investing, it's about choosing those solid companies, the ones with good track records, and then just holding on to them.
Exactly. You're letting those investments grow over time, writing out any bumps in the road.
Patience, huh?
A lot of it. And you got to trust in the power of compounding. That's where things really start to take off.
The video mentioned Apple and Amazon as examples, right? Would those be good examples of this long-term approach?
Definitely. I mean, look at how much they've grown over the past few decades. The investors who held on to those stocks, they did pretty well.
Yeah, I can imagine.
Of course, there's no guarantee that a company will keep growing like that, but those examples show that thinking long-term can really pay off.
Okay, that makes sense. But what about when things get a bit scary? When the market dips and we're in a bear market. The video mentioned some strategies for those times too, like looking for safe havens.
Right, safe havens. When the market's all over the place, some sectors tend to do better than others.
What kind of sectors?
Think about stuff like healthcare or consumer staples.
Essentials.
Exactly. People still need their medicine, groceries, those basic necessities, no matter what the stock market's doing.
True, those are always in demand. So you're saying investing in those companies can be a way to, ride out the storm.
Exactly. The video even mentions some specific companies like Johnson & Johnson or Pfizer in healthcare or Procter & Gamble, Coca-Cola in consumer staples.
Ah, I see.
Their earnings tend to be more stable and people always need their products.
So it sounds like during a bear market, it might be a good idea to move some investments into those more stable sectors.
It's definitely one way to manage risk and try to minimize losses when things are turbulent.
Now, remember that more advanced strategy we talked about before?
Yeah.
Short selling. I gotta admit, I'm still a little confused about how that works.
Yeah, it can be a bit tricky to wrap your head around at first.
For sure. Can you walk me through it?
Okay, so basically, with short selling, you're betting against a company or an asset.
Betting against them.
You think the price is going to go down, so you borrow shares of that asset from someone who owns them, sell them at the current price, and then you wait.
Wait for what?
Wait for the price to drop, of course.
Okay. And then,
If the price does drop, you buy those shares back at the lower price, return them to the person you borrowed them from, and you keep the difference.
so you're making money off the price going down.
Exactly.
But what if the price goes up instead?
Well, that's the risky part.
Risky how?
If the price goes up, you got to buy back those shares at the higher price, meaning you lose money, and there's no limit to how much you could lose.
Oh, wow. That does sound pretty risky. Maybe not for me.
It's definitely not for everyone. It takes a lot of knowledge and a pretty high tolerance for risk.
For sure. Well, speaking of risk, the video also had some good advice on managing risk in both bull and bear markets. What was it? Setting stop-loss limits?
Yeah, stop-loss limits are a great way to protect your investments from huge losses.
Okay, so how do they work?
You basically set a price, and if your investment drops to that level, it'll automatically be sold.
So it's like a safety net.
Exactly. It prevents you from losing more than you're willing to.
Makes sense.
Yeah.
Do you have an example? Right. A real-world scenario.
Sure. Let's say you buy a stock at $100, but you're a little worried about the market. You could set a stop loss at, say, $90.
So if the price drops to $90, the stock is automatically sold.
Yep, you're out, and you only lose $10 per share.
That takes away some of the stress, right?
Exactly. It helps you stay level-headed and avoid making emotional decisions.
Now, we keep talking about diversification, but I'm still not 100% clear on what that means in practice.
Okay, well, think of your portfolio as a pie chart.
A pie chart, all right.
Each slice of that pie represents a different asset class. You want to have a mix of stocks, bonds, maybe even some real estate.
So it's like stocks are the riskier slice, but with more potential for growth, and then bonds are the more stable slice.
Yep, that's a good way to think about it. And how you divide up that pie depends on your risk tolerance, how long you're investing for, and your financial goals.
So someone younger, investing for retirement, might have more stocks, while someone closer to retirement might have more bonds.
Exactly. It's about finding the right balance for you. And the video makes an important point. Diversification isn't a one-time thing.
It's not.
Nope. You got to rebalance your portfolio every so often to make sure those slices stay in line with your goals.
Rebalancing. What does that mean?
Think of it like a seesaw. You want to keep it balanced, right?
Right, so it doesn't tip over.
Exactly. Well, over time, some investments do better than others. Your portfolio can get unbalanced, like one side of the seesaw is heavier.
So rebalancing is like adjusting those weights to make sure the seesaw stays level.
Perfect analogy. You might sell some of your winners, the investments that have done really well, and buy more of the ones that haven't done as well, the laggards.
I get it. So it's like if your stocks have gone way up, you might sell some of those and buy more bonds to bring things back into balance.
Exactly. It's about maintaining that balance you set out with.
So this rebalancing thing, it is an ongoing process.
It is. The video suggests doing it every 6 months or so, just to keep things in check.
Wow, it sounds like a lot to keep track of. Is this something most people do themselves, or is it better to get help, like from a financial advisor?
That's a great question, and one we'll definitely be talking more about in the next part of our deep dive.
Okay, good. Because navigating all this, making those smart investment decisions, it does seem pretty complex.
It can be, but even if you're working with a financial advisor, it's super important to understand the basics. Be an active participant in your financial journey, you know?
Right, it's our money after all.
Exactly. We got to be informed and make the best decisions for ourselves. And that's what we'll continue to explore in the final part of our deep dive. We'll talk more about finding the right advisor, handling those tricky emotions, and really taking control of your financial future.
Sounds good to me. So be sure to stick with us for part 3, where we'll wrap up our bull and bear market adventure and give you all the tools you need to make those smarter investment decisions. And we're back for the final part of our deep dive into bull and bear markets.
Part 3, can you believe it?
Time flies when you're having fun, right? But we've covered a lot of ground, learned how to spot these market cycles, what causes them, and even some strategies to use.
Right, but remember that question from the Riqueza Vital video?
The one about how we actually use this knowledge to navigate the market.
Exactly. So how are we going to take all this info and put it into action?
That's the million-dollar question.
Well, I think one of the biggest takeaways from our deep dive is that market cycles are just part of the game.
Like, they're going to happen no matter what.
Yep. They're like the tide, ebbing and flowing. Trying to predict them perfectly is, well, impossible.
So instead of trying to time the market, it's more about Being ready for those ups and downs.
Exactly. Having a plan, a strategy that can adapt to whatever the market throws at you.
Makes sense. And that starts with knowing what you want to achieve,
Right.
your investment goals.
Absolutely. And how much risk you're comfortable with along the way. We talked about this before, but it's super important.
Right. It's got to be about your goals, not just chasing whatever's hot in the market right now.
Exactly. Once you've got those figured out, then you can start building a portfolio that fits.
And that's where diversification comes in again, right?
Spreading those investments around. The video mentions index funds and ETFs as good options for that.
ETFs. Those are those exchange-traded funds, right?
You got it. They're like a basket of stocks tracking a specific market index.
So instead of trying to pick individual stocks, you're basically investing in a whole chunk of the market.
Exactly. It's a good way to diversify, especially if you're just starting out or don't have a ton of time to research companies.
That makes sense. Okay, so we've got our goals, our risk tolerance, we're working on diversification. But what else can we do to, increase our chances of success?
Well, staying informed is key, right?
Right. But there's so much financial news out there. It's overwhelming. Where do we even start?
You got to be picky. Stick with reliable sources like the Wall Street Journal, Bloomberg, Reuters, those kind of places.
Those are the big ones, yeah. But what about going a bit deeper, beyond just the headlines?
There's tons of stuff out there. Books, podcasts, online courses, you name it.
Wow, so many options.
The key is to find resources that match your learning style,
Yeah.
and your level of knowledge.
Right. It's got to be something you can actually understand and use. But sometimes learning alone can be tough. Is there a way to, connect with other investors?
Yeah,
Learn from each other?
totally. Online forums, investment clubs, even some social media groups are good for that.
Like a support system, right?
Exactly. You can learn from others' experiences, share ideas, get encouragement when things get tough.
Because let's face it, those emotions, they can really mess with our heads.
Oh, yeah. Fear and greed, they can lead to some bad decisions.
So how do we handle those emotions?
The video has a simple but powerful tip. Write down your investment plan.
Actually write it down, not just have it in my head.
Yep. Put it on paper, make it a concrete plan. It's like a roadmap. It'll guide you when things get crazy.
So it should include my goals, my risk tolerance, my diversification strategy.
Exactly. And how often you're going to rebalance your portfolio. It's not set in stone, though. You can adjust it as things change.
Okay, that makes sense. But I know I'm guilty of this, constantly checking my portfolio, especially when the market's all over the place. Any advice for that?
Resist the urge.
Easier said than done.
I know. But honestly, the more you check it, the more likely you are to freak out over those little ups and downs.
And that's when we make those impulsive decisions we regret later.
Exactly. Take a step back, focus on the long term, and ignore those little blips.
It's about focusing on what we can control,
Right.
not what the market's doing.
Exactly. We can't control the market, but we can control how we react to it.
Okay, that's a good mindset shift. It kind of brings us back to something we've been talking about all along, learning and doing our research.
Right. The more we know, the better equipped we are to make good decisions.
And feel confident doing it,
Exactly. But for some people, that might mean getting some professional help.
like hiring a financial advisor.
Yep. The video mentions that not everyone has the time or expertise to do it all themselves.
A financial advisor is kind of like a coach, right?
Yeah.
Someone to guide you and offer support.
Exactly. But like with any profession, there are good ones and not so good ones. Do your research, find someone you trust.
Someone who gets you and your goals.
Exactly. So as we wrap up this deep dive, I want to emphasize that investing isn't just about the numbers and the strategies. It's about mindset. It's about embracing the journey, the ups and the downs, and using those experiences to learn and grow.
That's a great way to put it.
And remember, the most successful investors are the ones who keep learning, stay open to new ideas, and keep working on their financial knowledge.
That's a marathon, not a sprint, right?
You got it.
Well, this has been an amazing deep dive into bull and bear markets. I feel so much more prepared to handle whatever the market throws my way.
I'm glad to hear it.
A huge thank you to our expert for all the insights and guidance.
It's been a pleasure.
And to everyone listening, remember, stay curious, stay informed, and stay committed to your financial well-being.
The markets might be unpredictable, but your knowledge and your determination, those are your biggest assets.
And on that note, we'll wrap up this episode of The Deep Dive. Thanks for joining us, everyone. Until next time, happy investing.